Let's talk about the tax formula and an introduction to individual income tax procedures, ACC 124. With the history of taxation, it started basically in 1913 when the 16th Amendment was passed. Then from then on, they've basically done an income tax. They did do an income tax before 1913, but just sporadically when the government needed money, such as during the Civil War. But starting in 1913, we basically had a tax, and it's right in the Constitution. In the 1940s, Congress started withholding income tax from paychecks so they could get more revenue to pay for World War II. Before that, you just figured out your whole tax for the year in the spring, and you filled out your 1040, and you sent in the one check per year to cover the whole year's worth of taxes. But then they needed more money for World War II, and people wouldn't be able to pay the whole amount they owed in one check per year. So that's when they started taking it out little at a time from your paychecks to be able to get more tax money that way. Now, tax law has different objectives. In Accounting 101, we talked about the matching principle, and Congress does not care about the matching principle. They need to raise revenue, and they need to use tax law as a tool for social and economic policies. So, because of that, tax laws don't always make sense. Here are some words that we need to know. Taxable income. Also in your book is gross income. Includes wages, salary, self-employment if you have your own business, rent income, and investment earnings such as interest and dividends. It would also include if you get unemployed and you go get unemployment benefits. Sometimes it includes part of your Social Security and various other things. There are some incomes that are not taxable, that are not part of gross income, and those things include welfare, if you receive that, or if you receive child support payments, or if you receive food stamps and various other things are not included in this gross income or taxable income number. And we'll learn more about these things in Chapter 2. Earned income, when we use that word, we mean the income that you sweat for, such as wages or self-employment. You got to move, you got to do something, you got to work. Okay? Those things that you're doing that kind of thing for is earned income. Unearned income includes interest and dividends and unemployment income. Those things which you could earn while sitting in your recliner chair. Deductions are amounts you subtract from the income, and that's going to lower the amount of income that is then taxable. Credits can also reduce your tax, but they reduce your tax directly, and they're divided between non-refundable credits, which can only lower your tax down to 0, and refundable credits, which can lower your tax down to even below 0, where you get a refund even if you didn't pay that money in. These are the most wonderful credits as well. We'll be talking about credits in Chapter 6. Now, there's 3 different kinds of forms that you could file: a 1040-EZ, a 1040-A, and a 1040, also known as the long form 1040. The EZ is, as it says, the easiest, simplest one, and A is kind of in the middle, and the 1040 long form has everything you could possibly need is on it. So you choose the simplest form that you're qualified for. But if you have something that isn't on the EZ or A that applies to you, well, then you have to use the 1040. If you ended up making a mistake on any of those, then you can go ahead and amend your return by using a 1040X. So if we take a look at the 1040EZ, to be able to use that simplest one, you have to be either single or married filing jointly filing status. You cannot be head of household, you cannot be married filing separate, you cannot be a qualifying widower. You can only be one of these two filing status. You can't be older than 65, you can't be blind, because those things give you an extra standard deduction and there's nowhere to put it on the 1040EZ. You can't claim any dependents, so if you have any children or other dependents, there's nowhere to put them on the 1040EZ. The taxable income must be under $100,000. Only wages, salaries, or unemployment, those kinds of incomes are allowed. You can't have your own business on there, various other things. And if you have interest income, you can use that, but only if you have less than $1,500 worth of it. You can't claim a bunch of credits on there other than the earned income credit. Now, if you need to claim some dependents, or you have one of those other filing statuses, as long as you're not self-employed, and as long as you don't itemize, generally you could go ahead and use the 1040A. The 1040 long form is for anybody who can't either use the EZ or the A. Now let's take a look at the tax formula. You're going to need to memorize this. It's going to need to just be part of your everyday thinking. We're going to start out with gross income, and this is the same as what we talked about, this whatever income is taxable gross income. Then we're going to subtract out any adjustments, and this is also known in your book as deductions for AGI. And once I subtract out the adjustments from gross income, I get adjusted gross income, also known as AGI. This is one of the most important numbers there is. You're going to see it everywhere. So this number is at the bottom of the first page of your 1040 or your 1040A, AGI. Then from there, we're going to subtract two things. We're going to subtract out either itemized or standard deduction, whichever is more, and then we're going to subtract out exemptions. And once we subtract out those two things, we'll get taxable income. Now, the itemized deductions is where you figure out, okay, you have mortgage interest or what medical deductions you can take, and charitable contribution deductions, etc. We'll be talking about those in Chapter 5. There's also a standard deduction. This is kind of an average, like Congress just said, okay, here's a standard deduction that the average person might have this much stuff. And if you have the average or less than that of itemized deductions, then you can just use the standard, because that way you don't have to save all those receipts and calculate all the stuff up. You just use the standard deduction. But if you happen to be one of those people that happens to have more than the average worth of itemized deductions, then you will have to keep all those receipts and add everything up, and then you'll get to use your itemized deductions because it'll be more than the standard. The exemptions is you get one exemption, goes to each person, and the exemption, so if you have a married filing joint couple and they have a couple of kids, that's an exemption for the father, exemption for the mother, exemption for each of the two kids. So there'd be 4 exemptions there. And then every year you look up the exemption amount for that year and multiply it out times how many exemptions there were. You subtract the deductions and the exemptions from the AGI, you get taxable income. This is the income number that you're going to look up in the tax table to calculate out the tax amount. So if it's less than $100,000, you're going to look up in the tax tables, and you just need to know the amount, and there's a separate YouTube on how to calculate out the tax using the tax tables. If it's over $100,000, you have to use the rate schedules, and that's in the IRS instruction booklet as well, and we also have a YouTube on how to do that as well. So once I get the tax, the gross tax liability, I'm going to subtract any tax credits, the non-refundable credits and the refundable credits, and I'm going to subtract any prepayments. So that's the amounts that your employer was taking out of your check every week and sending to the IRS. And I'm going to subtract that out. If it's a positive, the gross tax liability minus your credits and prepayments is a positive number. That means you still owe some more tax to the IRS. You're going to have to write a check to them. If it turns out to be a negative number, then the IRS owes you a refund. Now here is some standard deduction and exemption information for 2015. For single, you get a standard deduction of $6,300. For married filing joint, $12,600. For qualifying widower, also known as surviving spouse, you get $12,600. Head of household, you get $9,250, and married filing separate, you get $6,300. There's extra a standard deduction that you're going to add to that if the person is 65 older or blind. They get an additional amount. And if they're unmarried, they get $1,550 added to their amount. If they're married, they get $1,250. So let's look at a single person. Their standard deduction is $6,300, and if they happen to be over 65, we would add $1,550 to that. So that would be $7,850 total standard deduction that that person would get to use. Now the 2015 exemption amount is $4,000. So if, as in the previous example, we talked about having 4 exemptions, we would multiply 4 times 4,000, and we would get to subtract $16,000 as exemptions. Here's an example, and we'll go through this and use the tax formula to solve it. John is 25, he's single, his salary is $28,000, he also got dividend income of $1,000. Now let's remember the salary he sweated for, that's earned income. Dividend income is still taxable gross income, but it is unearned income. In addition, he has deductions for AGI, remember that's adjustments, of $2,000, and he has $4,100 of itemized deductions if he counted up all his stuff that he could claim. He claims 1 exemption for this year, and we need to calculate the following amounts: the gross income, the deductions for AGI, i.e. the adjustments, his adjusted gross income, i.e. his AGI, the greater of the standard or itemized deductions, his exemptions, and finally his taxable income. His gross income is $29,000. How did we get this? We took the $28,000 of his salary and added the $1,000 of his dividend income. Both of those things are taxable gross income. We added them together, and his total gross income then is $29,000. His adjusted gross income is $27,000. We got that by taking his gross income of $29,000 and subtracting his $2,000 worth of adjustments. And 29 minus 2 is $27,000 is his AGI. The greater of the standard or itemized deductions, he had $4,100 of itemized deductions, but his standard deduction for a single person is $6,300. So that's more, so that's what we're going to choose. He had one exemption, and each exemption is $4,000, so we chose $4,000. Now to get down to the taxable income, we take the AGI, which is $27,000. We subtract out the $6,300 standard deduction, and we subtract out the $4,000 exemption, and we get taxable income of $16,700. We would then use that number to look up in the tax table and figure out how much his tax is. There are volumes of tax information available on the internet, including right on the IRS website. And there is a separate YouTube about how to get on the IRS website and look up different forms. They also have their own YouTube videos and iTunes podcasts, if you want to use those. Other good sites include hrblock.com, and there's many other sites as well. E-filing, many people, more than 50% of people use e-filing. You get your refund a lot faster with e-filing. Okay, and the IRS would love for everybody to e-file because it tends to have be more correct, and it is, of course, faster. Okay, taxpayers may prepare these e-file returns, these electronic returns, using their own PC, their own computer, and tax preparation software, or they can utilize a paid preparer who employs e-filing. Or, by the way, you can use a VITA program like we have at OC Tech, where the VITA volunteers do your taxes for free and e-file it for free.